Hi, this is a video in the series of accounting cycle videos. So in the previous videos, we have discussed different steps in the process of accounting cycle in the brief. So we have discussed recording of the financial transactions in the book of journal, then classification, posting of the journal entries into the ledger account after classification, and after preparation of the ledger, we go for summarizing, where we prepare the final accounts, which means the profit and loss account and the balance sheet for the financial year. So after summarizing, analysis of the financial statements and interpretation of the results take place. So this brief idea we have already discussed in the previous videos. So in this video, we'll discuss the first step of the accounting cycle, which is recording of the financial transactions in the journal. I will discuss. So this video will revolve around these 6 transactions. And first of all, in these 6 transactions, we'll try to know the two effects of each of the transaction, and after that we'll prepare the journal for these 6 transactions. So first of all, I'll read these 6 transactions for you, and then we'll try to come up with the two effects in each of these transactions. So let's start with the first transaction. Ram started his business of furniture with cash of rupees 1 lakh. So the two effects are, number one, the 1 lakh rupees has been invested in the business as capital. So capital is a personal account. So when capital brought into the business, so capital increases. And on the other hand, cash is an asset. And if cash comes into the business, cash increases. The cash balance of the business will increase. So these are the two effects of the first transaction. Then next, machinery purchase with cash of rupees 50,000. So here we have two financial entities in this transaction. One is machinery and the other one is the cash. Machinery is an asset, and when machinery is purchased, there is an increase in asset, and cash is also an asset. And if cash is paid for purchasing the machinery, there is a decrease in cash. The next transaction is goods bought of rupees 20,000. So we assume that we have purchased the goods for cash. So cash has been paid for purchasing the goods. The first entity here is goods. So goods purchase is an expenditure or expenses. So there is an increase in expenses, and cash has been paid, which is an asset. If cash is paid out of the business, it means there is a decrease in the cash, so cash goes out. So these are the two effects of this transaction. Next one is wages paid for cash. So we assume that this transaction is also for cash. I mean to say the cash has been paid in this transaction. So wages is the first entity. Payment of wages is an expense. So wages payment is increase in expense, and cash has been paid or given to the laborer. So cash is an asset. If we pay cash, so cash decreases or goes out of the business. So these are the two effects of this transaction. Next is goods sold of rupees 1 lakh. So here again we assume that this is a cash transaction. So goods sold or sales is an income. So income increases by 1 lakh rupees, or 1 lakh rupees sales happen to the business. So income increases and cash is an asset. So when we sell the goods, cash comes into the business. So there is an increase in the cash or asset. So these are the two effects of this transaction. Next one is depreciation provided on machinery of rupees 1 lakh. And the amount of depreciation is 10,000 rupees. So here we have two entries or the entities, the depreciation and machinery. Depreciation is an expenditure or expense, and machine is an asset to the business. So if we consume machine or if we use machine, there is a decrease in the value of machine, which is known as depreciation. So this depreciation is an expense. So here expense increases by 10,000 and value of asset decreases by 10,000. So these are the two effects of this transaction. So in this slide we will discuss and will try to know about the debit and credit effect of the first transaction, which is Ram started business with a cash of rupees 1 lakh. So as we have already discussed in the previous transaction, in the previous slide, that for each and every transaction there are two effects. So for this transaction the two effects are cash comes into the business for 1 lakh rupees and capital has been created against the business for 1 lakh rupees. So the two effects are cash is an asset to the business. So cash increases. So when asset comes in, it is debited. So cash account debit for 1 lakh rupees. And liability is a personal account. So Mr. Ram's capital is credited because Ram is the giver and Ram has given rupees 1 lakh to the business. So credit the giver. So these accounting rules have already been discussed in the previous videos. So for detail, please refer rules for accounting video. So that was about the two effects and debit and credit of this transaction. So let's move for the next transaction. The second transaction is machinery bought of rupees 50,000. So here machinery is the one entity and the cash is another second effect. So machinery is an asset to the business. So on asset we use real account rule that debit what comes in. It means if asset comes into the business, we debit this. So machinery comes into the business for 50,000 rupees and we debit the machinery by 50,000 rupees. And cash is also an asset. So for asset we use the rule of real account, credit what goes out. So the cash has been paid for purchasing the machinery, so cash goes out of the business and we credit the cash by 50,000 rupees. So machine account debit by 50,000 and cash account credit by 50,000. So these are the two effects of this transaction. In the transaction number 3, the goods are bought for rupees 20,000 for cash. So purchases is the one side or effect of this transaction and cash payment is another effect of this transaction. First effect and second effect. So purchases is an expenditure and cash is an asset. For asset we use real account rule and for expenses we use nominal account rule. If cash is paid, it means asset goes out. So credit what goes out. So cash would be credited by 20,000. And if there is an expenditure, so nominal account rule says debit all expenses and losses. So purchases account debit by 20,000. So here we come up with the journal entry debit purchases account debit by 20,000 and cash account credit by 20,000. So that was about the third transaction. Transaction number 4. Wages paid rupees 20,000 and cash has been paid for the payment to the laborers. So there are two effects. Number one, wage, which is an expense, increases, and cash, which is an asset, decreases. So for wages or expense, we use nominal account rule that debit all expenses and losses. So wages are debited. Wages account debited by 20,000. For the second effect, which is an asset or a cash payment, we use the real account rule that credit what goes out. So there is a decrease in the asset or the cash, so cash goes out of the business, so cash account credit by 20,000. So we come up with this journal entry debit wages account debit by 20,000 rupees and cash account credit by 20,000 rupees. So these are the debit and credit effects or the two effects of the transaction number 4. So the second last transaction is goods sold of rupees 1 lakh. So the sales are the ultimate thing that comes to the business in return of all the labor we do. So goods sold of rupees 1 lakh and cash must be received in return to the sales. So here we have two effects is goods are sold, it means income to the business, and cash received to the business, so cash is an asset asset increases, so income increases. So these are the two effects: income increases and asset increases. For income, we use nominal account rule. That credit all the gains and incomes. So we credit sales. Sales account credit by 1 lakh rupees. And cash increases. So for cash increase, we use real account rule. That debit what comes in. So cash comes into the business as we have sold the goods to the customer. So cash comes into the business and cash account debit by 1 lakh rupees. So that was the fifth transaction, and here we come up with the journal entry: cash account debit by 1 lakh and sales account credit by 1 lakh. So these are the two debit and credit effects of transaction number 5. Next we come up with the transaction number 6, which is the last transaction. Uh, the depreciation provided on machinery rupees 10,000. So here are the two effects. Number one, there is an increase in the depreciation. Depreciation is an expense. And there is a decrease in the value of machinery, which is an asset. So asset decreases and expense increases. So for depreciation, we use nominal account rule. That debit all expenses and losses. So we debit depreciation account debit by 10,000. And for asset, we use real account rule. That credit what goes out. So if there is a decrease in the value of assets, we will credit assets by that amount. So machinery account credit by 10,000. So here we come up with the journal entry: the depreciation account debit by 10,000 and machinery account credit by 10,000. So these are the two effects, the debit and credit effects of this transaction. So now, for every transaction which is recorded in the journal, there is a performa for the journal, a specified manner in which journal is prepared. So this is the performa for the journal. That the way we write or we record the transactions into the journal, the first column would be the date. The second column would be the particulars, where we will record the debit and the credit, the debit and the credit of the transactions with some narrations. A narration is a detail to the transaction. For example, the cash account debit to the capital account or the capital account credit. So what is that transaction? If you want to know, we can read the narration that Ram commenced business with cash, and the same for all rest of the transactions. So the third column is the ledger folio column. Ledger folio tells us where this entry has been transferred in the ledger, which is the second step in the accounting cycle. So account number say 105 is for these transactions, and in the ledger, in the account or page number 117, you can find the details of these transactions, and for these transactions 405 you can find these transactions. So this is the ledger folio number, the reference number. Using that you can find out the transaction detail in the ledger account. And the column number 4 is the amount. All the debit amounts are written in these this column number 4, and all the credit amounts are written in the column number 5. So after we are done with the preparation of the journal, we must match the total of the debit should be equal to the total of the credit. If so happens, it means you have prepared the journal correctly. So that was the basic idea about how we prepare or we record the financial transactions of a business in the journal. So thanks for listening. In the upcoming videos, we'll come up with the rest of the steps in the accounting cycle, which includes classification, and summarizing, and analysis and interpretation. So that's all for today. Thank you.